Show manufacturing has just stalled out. The Chinese are showing contraction. Germany, France, Italy, and the Eurozone all falling. The surprise is your UK, John. All we hear and see is headlines about how miserable everything is, but they're still expanding at 51.1.
Just miserable people, Mike. That's the problem.
Well, go Lionesses. They won yesterday. All right, the big number of the day is going to be the ISM PMI here in the United States. And one thing is we're seeing we have a different kind of manufacturing here than a different kind of problem here. We don't have the supply chain problems that China and Europe are having right now, and that is expected to come in at 52, down from 53, but still showing expansion. That's at the top of the hour.
What do you make of ISM services later this week, Mike, given what we saw in the PMI in the last couple of weeks?
Well, that's going to be interesting because we did see drops in PMIs in Europe, and we've seen it in China as well, although they're still positive. So the question is, did people cut back on spending, or did they do more spending? We thought they would do more in the service area, but the GDP and spending numbers showed for July they didn't. They still bought more goods. So it'll be an interesting number to look at.
My final word just on payrolls coming up Friday. You and I will have plenty of opportunities to talk about this, but what you're looking for going into this week?
Well, you're looking for a slowdown. That's what the Fed's been looking for, but we get jolts on Wednesday, and that'll show us if we've started losing some of those open jobs, and we're not expecting any change in unemployment according to the economists we've surveyed. So at this point, it's kind of status quo in the labor market, which Jay Powell says gives them room to keep cutting.
Do we see some heat come out of this labor market, and does that JOLTS data capture that with some reduced job openings? Mike, thank you. We're about 17 minutes into this. We're down 0.4% on the S&P. On the Nasdaq, we're down about a third. We recovered just a little bit, as Mike McKee pointed out. I know Mike very well. I'll pronounce his name properly. Mike McKee pointed out in about 13 minutes you'll get the ISM data on the manufacturing side in just a moment. JP Morgan's David Leibovitz wrote this: the economy is losing momentum. However, the Fed will continue to tighten, but it is not clear that the Fed can reduce labor demand job openings without pushing the unemployment rate higher. David's back with us for more. David, your thoughts on the data and just on that conclusion. If we're going to push the unemployment rate higher, does that mean we ultimately have to push this economy into a recession?
So I think that there are two things there. I think one, the PMIs obviously give us a very good look at data more in real time. And, you know, rather than debating 52 versus 53, I think what will be interesting to look at the trends that are emerging across manufacturing relative to services, because a thesis that a lot of people have had up until this point is that the manufacturing numbers should begin to get a bit softer, but the services numbers are going to hang in there. Regardless, the question is about the labor market. And I think what is so challenging in the current environment is that, you know, labor is the one thing that people continue to cite as keeping us out of recession. In order to deal with the inflation problem, it does feel like we need to have a recession. If you look back at the data to 1960, mid-cycle slowdowns do one thing. They prevent inflation from continuing to rise. They do not get inflation to fall. And so it does feel like a recession, albeit a mild recession, is becoming a foregone conclusion if we're going to put this inflation genie back into the bottle. The silver lining here is that when we look at the most cyclical parts of the economy, things like housing, business investment, inventories, and autos, nothing looks terribly offsides. And that does reinforce our conviction that any downturn in the economy would be relatively manageable and hopefully get inflation to a spot that makes investors and the Fed feel a bit more comfortable.
David, what do you think the biggest risk around that view is right now? Because you and I can both appreciate that's quickly become the consensus view, that if it's recession, and many people think it already is, it's short, it's shallow. What do you think the biggest risk around that view is?
So, you know, we've spent a lot of time thinking about that, and I've heard various other folks kind of espouse their theories. I think that the big risk there is that, you know, we end up seeing some sort of liquidity or balance sheet issue. I think one of the big distinctions of the current environment relative to what we saw in the run-up to 2008 and relative to what we saw during 2020 was that we see the potential for a balance sheet recession as being limited. But there's been massive wealth destruction so far this year. People are hanging on because incomes are growing and they do have accumulated savings, albeit they're not interested in seemingly spending those accumulated savings. I think that a balance sheet recession, something that really squeezes the consumer like we've seen over the past two downturns, is the biggest downside risk to our base case view.
Just quickly then, one final question from me, David, and I'll let you run, and thanks for all your time this morning. It's really important to us. Just a final question. Do you expect the weakness that we're starting to see evolve spill over into the labour market this quarter, or is that too soon?
So I think that you are going to see the labor market numbers begin to soften. I've always been a big fan of jobless claims because it comes out every week, and the claims data has been steadily marching higher over the past couple of weeks. And so I think that, in concert with what you're hearing from corporations during earnings season around expense management, leads me to believe that the labor market numbers are going to begin to get a bit softer here over the course of the coming months.
David, thank you, buddy. As always, good to catch up. David Leibovitz there of JP Morgan Asset Management. About 21 minutes into this, we're down a third of 1%, recovering slowly on the S&P. On the Nasdaq 100, we're lower on the Nasdaq. We're down about 0.2%. Abby, we've got to catch up about that Apple story. They are very, very good at timing this debt market.
They certainly are, John, and it's interesting because you were just mentioning futures off the lows. That has a lot to do with Apple, because after announcing that four-part bond deal, that 40-year deal, about 140 bips above, 150 basis points over Treasuries, Apple had been down about 1%. That had really dragged on the markets. Moments ago, up 0.3%, up slightly right now. But to your point about timing it really well, of course, in the back half of July, we saw this big rebound in credit as investors and traders became more optimistic. So Apple taking advantage of that to fund corporate uses, mainly dividends and buybacks, according to one source. But they have no shortage of cash, John, as you know, about $180 billion. And historically, because this is actually the fifth bond offering over the last roughly 5 years, on the day of the announcement, the stock closes up more than 1%. So today's reversal, no surprise. And if it goes up more than 1%, that would be right in line with the history of Apple.
Abby, thank you. Larry McDonald over at the Bear Traps Report sent me a chart months ago of Luca Maestri, the CFO of Apple, just plotting where he issues debt in the credit market and the timing of it, and then what happens with credit spreads after they widen, interest rates start to climb. Just a fantastic timer of this credit market, it seems, and I know a lot of people are talking about that this morning, going into potentially a busier August relative to what we've seen so far this year, so far this summer on the supply side. Just one thing to watch. Here's another, of course, Speaker Pelosi and her trip to Asia. Will she or won't she land in Taiwan? That is a huge, huge focus of this market now, going into tomorrow off the back of recent reports suggesting she could be landing there tomorrow night, local time. We'll build on that story through the day on Bloomberg TV and on Bloomberg Radio. Coming up, I'll get you the trading diary, the expected scheduled events of the week ahead, and there are many. From New York, this is Bloomberg. Coming off the back of the biggest month of gains on the S&P 500 since November 2020, about 25 minutes into the month of August, we are lower by about 0.1%. No drama here, just a bit softer, lower, negative, lighter on the S&P. Add a little bit more weight to the Nasdaq 100, up about 1/3% or so. That's the price action. Here's your trading diary at the top of the hour. ISM manufacturing numbers coming out. Speaker Pelosi continues her tour of Asia in Singapore. Plus tomorrow, Fed speak from Evans, Bullard and Mester on Tuesday, along with the US JOLTS report. A Bank of England rate decision and initial jobless claims coming up on Thursday. Some talk of 50 basis points on Threadneedle Street later this week from Governor Bailey and the Bank of England. And finally, we round down the week with the main event on Friday. It's the US payrolls report, and I can tell you a ton of data in between. We're looking for 250k on Friday. The range, the high 320, the low is 50. From New York, this was the countdown to the open. This is Bloomberg.
Gordon.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, August 1st. Here are the top market stories we are following for you at this hour. Kashkari is committed. The Minneapolis Fed president says the central bank will do what's necessary to bring inflation back down to 2% as the market bets on a pivot. We'll get the latest read on the economy with ISM manufacturing data dropping now. Better than feared, Goldman says earnings season is shaping up well so far, but Morgan Stanley is looking at estimate cuts and expects the rally to fizzle out. We'll get the view from Dennis Deboucher of 22V Research. And to Taiwan or not to Taiwan? That is the question as House Speaker Nancy Pelosi travels travels in Asia with Taipei currently absent on her itinerary. China reiterates its opposition and says it won't sit idly by if she visits. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. Guy, it's Monday, it's a new week, it's a new month, and yet we're still having a conversation about risk of a recession.
Absolutely. The data matter. The data are going to be important. The Fed says that, so we're probably saying that as well. And as we're talking of the data, let's talk about what is happening with this ISM manufacturing number, which is hitting the screens in front of us right now. I think it's fascinating what we're getting here. The headline number dips, but not as much as anticipated. Comes down to 52.8 from 53. Still in expansion territory. The range there, 50 to 54 from economists. The prices paid number is where life gets interesting. It dips from 78.5 to 60. Economists were expecting 74.3. The range there, 66 to 77. So even that number is below the bottom of the range economists had anticipated. New orders come in at 48.0, down from 49.2. But the employment number ahead of Friday's employment number comes in a little better than anticipated, and certainly above last time round, 49.9 versus 47.3 last time round. Economists looking for 48 there, Kaylee. So in general, the headline number is better than anticipated. There's a big drop, though, in prices paid, which is something I think we need to explore. So let's do that right now. We bring in, for instance, an expert analysis, Timothy Fiore, the chairman of the Institute for Supply Management's Manufacturing Business Survey Committee. Tim, great to see you. Walk us through the numbers. How should we be reading them?
Okay, so we continue to expand at moderate kind of levels here. But if you notice all the indexes, they've only moved 1.5, maximum 2 points. They're not, the headline indexes, the ones that go into the PMI, they're not moving dramatically. So we've had a definite shift of adjustment here. Let's talk about demand first. New orders continue to contract slightly. No big deal. An expert in this area kind of advised me that, hey, look, when the new orders are above 40, you don't have to really worry that much about a recession coming. So that's a really interesting point. New export orders came up a bit, which is really good. Backlog is shrinking because new orders are slowing down, still because we have over-ordered over the last year and a half. And I think the only thing on the demand side is that the customer inventory number kind of crept up closer to 40, which is an indication that at some point in the future, customers aren't going to need as much inventory. So, hey, demand's solid here, I think. There's some indications. We had panelists reporting that things are softening again, but that softening could be well outside of a normal order stream. So the story is really on the supply chain side this month. Well, we're sitting there now at 55.2 on supplier deliveries. The situation is getting better, and it's demonstrated by the fact that prices are coming down too. Those kind of follow together.
Well, to that point, Tim, on prices coming down, it's the biggest fall in the prices paid index since 2010. What is the signal there as to whether or not that decline is durable?
Well, it's the fourth largest drop since we started keeping numbers in 1948, which I think is really cool. So, but I think a lot of it has to do with energy coming down over the month. But we also see steel slowly coming down too. Aluminum prices are coming down. Copper prices are coming down primarily because of the softness in China. But we seem to be coming into a level now that's much more towards equilibrium. The issue that is still in front of us is that lead times really haven't changed much. And I'm really waiting for the lead times to start to contract. We had lead times come down a little bit on CapEx, but not significant. I'm hoping in the next 2 or 3 months we'll see lead times come down. Coupled with the prices coming down, you'll see the new order rate pick up again.
Tim, just to stay on that number, the prices paid number, the rate of change, as you've indicated, as Kelly's indicated, is substantial. But what you're saying is basically you think it's going to come down and now stabilize. Is that the right read here? Or do you expect the next month's number to deliver another sizable downturn on that figure as well?
Well, I don't really think so, because I think we're at a kind of an equilibrium here. We're getting close to that. I mean, the 60 number on the prices is maybe 2 to 3 points higher than you really want it to be for equilibrium. You want the supplier delivery number to be 55 to 59. That shows a normal stress between the supply and demand. You want the prices number to be kind of 55 to 58. We're not quite there yet. I don't see a drastic fall off. Like I said, that new order number staying above 40, significantly above 40, leads me to pause and think that we're in a pretty good place. I mean, the other issue that's happening here is that we had a lot of comment from the panelists about manufacturing inventory. And they're concerned about the future, no doubt about it. They don't want to get stuck with all this extra inventory at their facilities or with their supply base. So that has a lot to do with the new order rates dropping because we've kind of over-ordered. But they're positioning to make sure that working capital can be positive. in spite of a downturn at some point in the future. So they're being very cautious here. Last month, we reported that the new order rate slowing was primarily because lead times were so extended and prices were so high. This time, there was a clear indication in the survey comments that they are concerned about being stuck with a bunch of working capital, i.e. manufacturing inventory, that they're not going to be able to relieve during a normal cycle. So that's kind of the story for the month.
Okay, Tim. Well, of course, it is Monday. By the end of this week, we'll be talking about the non-farm payrolls report at this hour. So on the employment side, that index back up near 50, just a tenth below it. What are you seeing on the labor pressure side for manufacturers?
Oh, thanks, Kaylee. Great lead in. So we're still 7-to-1 companies hiring versus attriting. There's no comments really about layoffs at this point. You see it in the media, though, that a lot of large companies are positioning for layoffs. Some are laying off. The majority of them are indicating that they're going to trim their overheads or their general overhead headcounts in the future. They're not really saying this week, next week. So that's a positive thing. Our panelists are still hiring at a 7-to-1 rate, and that 1 out of the 8 is really attriting out or freezing. So we're not in a layoff environment at all. They're still having difficulty. The quits rate is still elevated. The general headline comments around labor are still indicating that they're still struggling with getting people and they need more. So, and that's primarily why the production number really hasn't come up. But, contracting employment number is a result of the panelists not being able to add to the headcount on a month-over-month basis. It's not because they don't have the demand.
Be interesting to see what the JOLTS number says tomorrow as well. We'll review that data at this time tomorrow. Tim, final quick question from me. Manufacturing data outside of the United States are slowing rapidly. You're seeing it. We saw it in China. We've seen the data out overnight. The European data as well is also indicating a fairly rapid industrial slowdown. What is the relationship with what is happening ex the United States to what is happening within the United States? Can you draw a line between those two? Because at the moment, it feels very different.
Yeah, I can give you an overview. So, China contracting, they've been very sluggish now for a year and a half. And China contracting really means that Germany is struggling too, because, German exports go to China in a big way, and China's single trading partner is probably Germany from the standpoint of capital investment. The numbers that you see in the European theater are different from the ISM numbers. They tend to overweight new orders and underweight inventory. So you can't really align them one for one with ISM's numbers. We don't run in the European theater. Our numbers are all U.S. We equally weigh the 5 sub-indexes that go into the PMI number, and we've been doing that for, 70 years. So you can't really do a direct correlation. But, hey, Europe, no doubt, is not strong, but it was encouraging that we saw new export orders come up in the month. And China, I think, is driving that German-Chinese situation. And I'm not sure how that's going to be resolved in the short term anyway.
Yeah, we are all looking for developments on that. Tim Fiore of the Institute of Supply Management, thank you so much for joining us. Now coming up, we'll continue the conversation about the economy as well as Federal Reserve policy and the fight against inflation. There's a fiscal angle to this as well. Senator Pat Toomey of Pennsylvania will be joining us next for an exclusive interview. This is Bloomberg.
Earnings season is here.
Everything I've read has just got the R word. Resilience, not recession.
Earnings are expected to be so weak that I think that presents a very intriguing opportunity.
Bloomberg breaks the numbers first.
We get a deluge of earnings globally this week from Alphabet and Microsoft.
With exclusive expert analysis.
These earnings have proved to be really inconsistent, not actually showing a real picture that goes one way or another.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Bloomberg Markets. I'm Kaylee Lyons in New York with Guy Johnson in London. And also joining us now, David Westin, anchor of Bloomberg Balance of Power, who is sitting down for an exclusive interview with U.S. Senator Pat Toomey. David.
Thank you so much, Kaylee. So, Senator, thank you so much for being with us here in New York. So let's start with this Inflation Reduction Act, as they're styling it. And I guess my basic question is, you and I have talked before, you are concerned about the deficit. You're concerned about getting the deficit down. If you believe this would do that, would you be in favor of it?
No, not doing it this way, and I'm very doubtful that this is actually going to accomplish that. If you look at what this consists of, David, right, it's a very significant corporate tax increase, mostly focused on manufacturers, which is a bad idea. It's combined with price controls on prescription drugs, which is both unnecessary and a very, very bad idea and a terrible precedent. And the money is mostly going to go to subsidizing corporate welfare for green energy companies, for wealthy people to buy Teslas, and for relatively affluent people to get a political payoff that's pretty blatant in the form of the subsidies for Obamacare for 3 more years. That's this package, and I've been asking myself, what does Joe Manchin get out of this? And of course his answer is, oh, we're going to streamline the permitting process. Oh, really? We've seen no bill. We have no text. They're not putting it in this bill. And we have not identified the 10 Democrats that would have to join with 50 Republicans if there actually were a constructive permitting expedition process. The process were expedited. And the fact is, most Democrats don't want to expedite permitting for fossil fuels. They want to keep it in the ground. They don't want to facilitate the infrastructure to move it around. So I am very, very dubious about
So
this.
let's come back to the deficit reduction part of it, because the way they pencil out on something like $400 billion you've reduced over 10 years, you're questioning that as a practical matter. What in the math doesn't add up to you?
So what I'm skeptical about, a couple things. First of all, I think the fact that they effectively undo one of the most constructive things we did in the 2017 tax reform, which is allow full expensing of CapEx, is going to lead to an economic slowdown.
How constructive was that? Because I went back and looked at some of the numbers on Bloomberg, and the numbers bounce around on CapEx, but they didn't clearly go up under the 2017 Act.
I thought there was an increase, and I think there is an increase. And if you think about it, we lower the cost of capital expenditure, right? The after-tax cost goes down. If you lower the cost of something, all else being equal, it's likely that there'll be more of it. They're definitely going to raise the cost of CapEx, and that's why the Joint Tax Committee believes that half of this whole burden is going to fall on manufacturers. So that's one aspect. The other thing is they use this great Washington fiction of counting 10 years worth of tax revenue increases against 3 years of expenditures in a program that they fully intend to be permanent. I'm referring to the Obamacare subsidies. You know, the way they pencil that in, it all goes away in 3 years. We know that's not going to happen, in part because the last time they did this, they extended it for 2 years. The 2 years is about up, so what are they doing? Right before the election, extended another 3. That's going to continue.
In fairness, when you talk about Republicans have been known to do that as well. There was some of that in the 2017 Act as well, as I recall.
Okay, both sides have been guilty of budget gimmicks from time to time. There's no question about it. But you asked me about this bill, and that's why I'm very doubtful.
What about IRS enforcement? Why shouldn't we do what we can to make sure people pay their taxes?
I think if it's done properly, you can defend that. I think the IRS does have antiquated systems, and there should be investment in upgrading that. But if it's going to be about harassing a lot of small business guys, I'm not sure that's very constructive.
You talked about tax gimmicks, and let's talk about the PACT Act. I have to always remember what it is. It's a promise to address comprehensive toxic act. This is the burn pit issue, and you've taken some issue with the bill as it is. Let's be clear. What are you for in this bill, and what are you against in this bill?
That's a very good way to put it, right? So what I'm for is the entire set of provisions that will provide new and more generous benefits in health care and in disability compensation for veterans. So I've not suggested any change at all in the substance of what the bill is supposed to be about. And the changes that I'm looking for would not reduce spending on behalf of veterans by a penny anywhere throughout the entire federal government. What I'm against is a completely unrelated provision that was put into this bill. It's a very complicated technical change in the budget rules that makes it easier for future Congresses to spend more money. And it could be as much as $400 billion over the next 10 years. What I'm in favor of is keeping the budget rule as it's been for many, many years, not making that change that's completely unrelated to delivering benefits for veterans.
My understanding is the other 400 number here would be moving from discretionary to mandatory. But isn't that 400 number itself for various health benefits? That's what's wrong with making that mandatory?
Because it doesn't change the ability of the government to make those payments to cover those services. This is an accounting change. This is a change in the way the government chooses to categorize the spending that's going to happen either way. If it is categorized as mandatory spending all of a sudden, which is the change that this bill would do to existing programs, the reason they want to do that is because it then frees up $400 billion underneath the spending caps that discretionary spending is subject to, and it allows for this spending spree on unrelated things.
But doesn't Congress have the keys to its own jail there? I mean, when that came up, it can change those spending caps, can it not?
Yes, so that is an argument that says, why have any budget rules? Because sure, Congress always has the keys. Congress can always undo anything. It can pass a new law. But we nevertheless do set up some guardrails in the hopes that that will provide some constraint on runaway spending. It hasn't worked real well. I'm not in favor of taking down what few guardrails we have.
So you're taking a lot of hits on this, obviously, in the press, Jon Stewart and others. How do you get out of this? How do you preserve what you think is important in this bill and still fix the problem you have?
So look, I don't know whether I'll be successful in getting rid of this extraneous gimmick for a spending spree, but what I've suggested is there's kind of an old-fashioned way to address this. Let's have a vote. Let's see if there's a majority of the Senate that agrees with me, or if a majority of the Senate disagrees with me. I'm going to have to live with that outcome, and that's what we ought to do. So I don't know whether Senator Schumer will allow that. He generally doesn't like votes on amendments as a practical matter. But if he'll agree to doing it here, then we get this resolved. And by the way, however it gets resolved, either way, the very next vote can be passage, which will get 85 votes. And if my amendment succeeds, I'll vote for it.
So Senator, finally, when you're talking about votes, there also looks like there's likely to be a vote on that Inflation Reduction Act, as they call it. There seems to be one critical vote, maybe with Kristen Sinema from Arizona. Are you talking to her these days?
I talk to Kristen very regularly. I consider her a friend. I think she's a great senator. I think she's very effective. She's very smart. I think that her relative silence on this, unless I've missed something recently, is kind of conspicuous. I don't know what it means. I'm not speculating about what she's going to do, but I do know there are some provisions in this deal that she has had reservations about in the past. So I'm looking forward to chatting with her this week about what she thinks of it.
And we'll look forward to hearing the results of that chat.
All right.
Okay. Thank you so much, Senator. Great to have you with us. That's Senator Pat Toomey of Pennsylvania. Back to you, Guy Johnson.
David Weston, great interview. Very interesting. Thank you very much indeed. Bloomberg's David Weston, Senator Toomey. Gentlemen, thank you. Still ahead, House Speaker Nancy Pelosi now in Asia. The question is, will she travel to Taiwan despite China's warnings? We'll have the latest next. This is Bloomberg. So China is warning again that its military will take action if House Speaker Nancy Pelosi makes a landmark visit to Taiwan. Pelosi is currently in Singapore. Bloomberg's Washington correspondent Amory Hordern joining us now with the story. Amory, increasingly it looks like she is going to go. Then what?
Well, she's going to have some meetings there, right? But of course, the big question is, what will the Chinese military do? There's a few factors at play. One, the PLA, the People's Liberation Army, China's military, is celebrating its 95th anniversary today. So you have seen a number of live military exercises, especially off the province that is directly away from Taiwan. And the rhetoric has continued. This morning, we heard yet again from China's foreign ministry, who said the PLA will not remain idle. And what they do depends on whether Speaker Pelosi comes. And they also reference the fact of her rank. She's the third highest ranking U.S. official after the president and the vice president. So the risk here is that there is some sort of aggression or provocation, given the fact that for days China has warned about this. The issue on stateside is that Speaker Pelosi, if she does not go, the Republicans will then just use that as amplification and fire into the midterm elections. We're now just under 100 days away, and saying that this administration, the Democrats, are soft on China. So it's a very tricky situation at this moment for all sides, but all the reporting out of Taiwan, also the Wall Street Journal just reporting, CNN reporting that she is expected to go.
Okay, so obviously the implications are both domestic and geopolitical in nature. Anne-Marie, on those geopolitical consequences, we understand China has warned about not sitting idly by, of taking some kind of action. Do we have an understanding of what the U.S. response to any kind of provocative action would be?
We don't, but we do know that if she was to go, she'd be accompanied on a U.S. military Air Force on her way there. We did hear, though, from Admiral Kirby today, earlier on MSNBC. I'll bring you a little bit of what he said. He says there's nothing unusual about this, speaking about the visit, and it's quite frankly disconcerting that the Chinese might use this as some sort of pretext to actually increase the tensions. He then went on to talk about the fact that the months before this trip and the weeks before this trip was even in the vernacular of the media, that there was the Chinese that have been increasing the tension on the Taiwanese Strait. They've also been saying that it's no longer international waters. So there has been a lot of tit for tat around this. The other geopolitical concern is, of course, that both teams, the Biden administration as well as Xi Jinping's team, since their phone call, have been trying to organize an in-person meeting. That would be the first for the Biden administration, and this clearly will just potentially complicate that.
Nevertheless, domestic politics probably front of mind for Biden right now. What is if Pelosi does go, what does that do for Biden in the midterms?
I think the Democrats would just use it as, we're willing to talk tough on China, we're willing to stand with Taiwan, but at the same time they will say that they have not moved away from the one China policy. We've seen the president a number of times, though, have a few comments that the White House had then actually had to walk back, and this was, of course, in reference to Taiwan. But her going would definitely potentially help the Democrats, but I would say her not going would really fuel the fire to the Republicans. This would be a huge talking point for them leading up to the midterms just after inflation.
All right, well, we will await to see whether or not she does indeed land in Taipei in the next 24 to 48 hours. Bloomberg's Anne-Marie Hordern, thank you so very much reporting for us from Washington. But coming up, we'll turn back to the markets because it's another heavy earnings week, and our next guest says the market rally can continue. Dennis Dubasher of 22V Research, the founder there, will be joining us next. This is Bloomberg.
About that all day yesterday.
In the face of deglobalization, neutral is likely higher. Their models haven't caught up to that yet. And I think that's what so many of us are sort of pounding the table about. It's going to have to be a higher terminal rate.
That was FS Investments chief U.S. economist Lara Rame on Bloomberg TV earlier. Well, we're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. And Abigail, after the best month for stocks since November 2020, not exactly a rip-roaring start to the new month.
No, there really is not. And it's a little bit of a roller coaster ride so far, Kaylee, because right now we have that S&P 500 down about 0.4% earlier in the pre-market ahead of an announcement by Apple, which I'll be mentioning in just one moment. Futures have been up slightly, then down almost 1%. Then recovering and now lower. You can see the NASDAQ 100 keeping a small gain up about 0.2%. Much of it has to do with Apple and, of course, that announcement of a four-part bond sale to fund both dividends and buybacks. The company, of course, already has a huge cash store of about $180 billion. Apple earlier had been down 1%. Now it's slightly higher. This is the fifth bond offering from Apple over the last roughly 2 years. On the days that those last bond offerings were announced, the stock closed up by more than 1%. If that happens today, maybe we're going to look at a bullish reversal. Where we're certainly not seeing a bullish reversal, we're seeing a pretty bad bearish reversal, is oil down nearly 7%. That is really weighing on the oil complex, the energy complex. Halliburton, Valero, and Devon all down sharply. And what's so interesting, of course, about this earnings season is that while in some ways it's been better than feared, with a lot of companies beating just a little bit, that could reflect management's managing well, we're actually seeing a large number of downgrades as opposed to upgrades going all the way back to 2020. You can see that here with this action over the last earnings season. And then, Kelly, of course, a macro tailwind, headwind, I should say, really more so, although it actually could turn out to be a tailwind, is the Fed. So, of course, in September, the Fed is expected to raise by another 50 bips and then continue to raise, but slowly. And this is really so interesting. Sometimes I think, Guy, that market analysis and traders really get a little bit into the weeds. Somehow traders are really pricing in cuts next year, and this is really going through to the real world. I was talking to a real estate broker just last week, and she was talking about how she has one client who they're renting for the next 6 months because rates rising, and then they're planning on buying next spring because of rates going down. If it can be that neat, it'll be surprising, but who knows?
The markets do seem to be at the moment trying to price in the perfect landing. It is incredible to watch what's happening here. July was incredible. Abigail, thank you very much indeed. Bloomberg's Abigail Doolittle on the markets. Let's carry on the conversation around this and whether or not the Fed actually needs to push back on this narrative. Former New York Fed President and Bloomberg opinion columnist Bill Dudley is calling on the Federal Reserve to take action. In his latest column on the Bloomberg, he has said this, quote, "The outlook hasn't changed. Inflation is too high. The labor market is too tight, and the Fed must respond. Wishful thinking in markets only makes the job harder by loosening financial conditions and requiring more monetary tightening to compensate." Not mincing his words, as ever, Mr. Dudley. And that brings us to our question of the day. Will the Fed be pushing back? We've already heard from Kashkari. We've got a lot of commentary coming up from the Fed over the next few days. Dennis Debuchet, 22V research founder, joining us now to give us his take on this. Dennis, great to have you on the program. Does the Fed need to push back? Will the markets react when they do?
I think there's going to be some form of pushback. I don't think you can depend on, if you're bearish, the Fed governors bailing you out, so to speak, by pushing back aggressively. Unless the data comes in hot enough, then I would focus really on payroll and CPI to justify them coming back and pushing aggressively. I mean, there's so much commentary out there about what the neutral rate is. No one really knows what the heck the neutral rate is. We're only going to know in hindsight as the data rolls in. The Fed has made this very, very clear that they're data dependent. So if the data is going to justify them tightening more, that's what they're going to do. And I think people are getting way too caught up in this kind of short-term idea of them coming in and, tightening financial conditions aggressively in the next few days via open mouth operations that'll help, drive the market lower. So I think we're just in a wait and see mode to see what does payroll do, what does CPI do, And then from there, we can have a better understanding about what the Fed is going to do on a go-forward basis.
Yeah, there's a lot of data to come between now and Jackson Hole, and even more between now and actually getting to that September meeting, Dennis. So as we look at the market rally we saw over July, which was monstrous, the best since November 2020, how much of that do you think was attributable to these expectations that the Fed is going to pivot, is going to blink, and how much of it was actually fundamental in that earnings haven't been as bad as we were all worried about?
It's a great question because I do think it was a significant amount of both. Certainly earnings did not come in nearly as bad as many people had feared they would. Companies are still returning a massive amount of cash to shareholders. And if 10-year yields are coming down at the same time, then your fair value estimates go up. How much they go up is a kind of a totally different discussion. But keep in mind that when the Fed made very clear in June that they were going to crush inflation, that sent off a wave of things that followed, including 10-year yields coming down aggressively and businesses getting the joke that demand growth needed to slow aggressively, so CapEx expectations come down. At the same time, you have an inventory overbuild, along with much better financial conditions that help lower demand growth aggressively. And by extension, I should mention this, you saw it in the ISM today, prices paid are coming down across the board. So you have a little bit of fundamental reason for a little more hope, because as the data slows and as inflation comes down, the odds that the Fed has to drive the economy into a depression to accomplish their goal goes down significantly. As that goes down, tail risk is reduced, and that's why you see a bounce in the market, especially if earnings are coming in okay relative to expectations and cash returns are still relatively healthy.
So how far can this rally go? Even if it's a bear market rally, how far can it go, Dennis?
I think you're probably up, around here is about as far as I'm willing to call it going until the most important questions are answered. So I would say the 4,200 range, 4,300 range, if you get really, a lot of people are caught offside, still too short and have to cover. And the reason I'm not comfortable chasing it much higher from here is because the main question still needs to be answered. And that's what we all need to be discussing. And the main question is, how deep is the slowdown going to be? The Fed is engineering a slowdown. Whether it's fast enough for Bill Dudley or Larry Summers is another question. But they are engineering a slowdown. And the question remains, is it going to be no recession, mild recession, or deep recession to accomplish their goals? And if it turns out that it's just a softish landing and a couple of quarters of below trend growth or a year of below trend growth, and they start to look like they're accomplishing their inflation goals, the market could go up a lot. But as you and I very well know, monetary policy is a blunt tool. And that blunt tool could lead to significantly lower economic growth in the future. Inflation can be sticky too high, and the Fed has to do more, which introduces that downside tail risk to economic growth. And so it's really tough to be chasing markets until we really know how deep the slowdown is going to be, not to mention what's going on in Europe, Chinese economic growth, et cetera.
Well, on the subject of the slowdown, though, what we hear often from those on the more bullish end of the spectrum is we're going into this in a very different place than we go into usual recessions, in that the consumer and corporate balance sheet is so incredibly strong. And I'm wondering if there's a correlation between an economic recession and an earnings recession that may just be a break from pattern given the unusual position we find ourselves in at this moment.
Yeah, you bring up a good point, and I think it should be understood by investors that the fact that the labor market is strong and the economy overall is relatively healthy and not levered actually works against us here. It does mean that the Fed might have to tighten a lot more, right? The stronger the labor market is, the more persistent inflation will be. So that's something just to keep in mind. Relative to your question on, which is a sense, nominal versus real GDP growth and what earnings, what happens with earnings, you can actually take the opposite call on this, because I think a lot of people have this messed up to a certain extent. Let's just say we get negative real GDP growth, but inflation is sticky high and nominal is +2, +2.5% or something like that. That means that companies are still passing on costs, because you get inflation because companies are passing on those costs, which means that even if you have zero real or below, you might still have positive earnings growth. And I don't think a lot of people have thought about that. So what I'm actually most worried about is not nominal staying too high. I'm worried about pricing collapsing because we have a deeper recession and you get both a margin contraction the really hard way, which is wages being a little too sticky on the downside if your top line collapses. Companies can't pass along costs.
Where do you see that? Where's the biggest risk of that happening? And on the flip side, where is it priced best, i.e. what looks cheap relative to everything else?
Yeah, so cheap's the eye of the beholder, as you know. I would say there's one area that is particularly interesting over the next 2 years if you avoid a deep recession. That's going to be energy, right? There's probably some issues for deep recession near term to the extent that the economy slows aggressively. But if you avoid a deep recession, given what we know about supply constraints, energy is going to be, probably do okay. On the other side of that, I would say, and people hate this answer, but defensive large cap tech, all the things that were supposed to blow up in earnings season, those companies have very low labor costs relative to the rest of the index. So that is a massive benefit. And of course, they're monopolies, that also helps. So that's a really massive benefit on a go-forward basis, to a kind of cost relative to pricing point of view.
Finally, Dennis, where's your year-end target now? You were north of 5,000. Are you still there?
No, we're not even close. We're probably the 4,300 range.
Okay, so you essentially see very little upside from here.
Yeah, because I can't answer the question on recession and how deep it will be, and I doubt we'll be able to answer that question before the end of this year. That it makes it tough to change that forecast.
All right, Dennis Dubashere, 22V Research founder, thank you so much for joining us and sharing some of your insight with us today. And coming up, how will inflation and disruption in the energy business affect Americans' utility bills? Obviously, they already are, but we'll take a look at the forward picture and talk with the CEO of the company that handles almost a third of the natural gas in the United States. Alan Armstrong of Williams is up next. This is Bloomberg.
And keeping you up to date with news from around the world, here's the first word. I'm Rishika Gupta. In eastern Kentucky, the death toll from massive flooding has now risen to 28, and the state says more fatalities are expected. Rescue and recovery efforts were slowed Sunday by up to 4 more inches of rain. About 400 people have been rescued by National Guard helicopters. President Biden is isolating at the White House after testing positive again for COVID. He has a so-called rebound case that is seen in people who take the antiviral drug Paxlovid. The White House says the president is not experiencing any symptoms. And in sports, there are multiple reports that Cleveland Browns quarterback Deshaun Watson has been suspended for 6 games for violating the NFL's personal conduct policy. 24 women in Texas accused Watson of sexual misconduct. He's denied any wrongdoing. The NFL Players Union has said it would abide by the decision of the disciplinary officer. The league wanted a longer suspension and could still appeal. Global News, 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg. Kaylee.
Ritika, thank you. Well, the Senate Democrats' climate and tax spending deal would impose a number of new taxes and fees on the energy sector. Meanwhile, like every other industry, energy is having to deal with soaring inflation. With us now is the CEO of natural gas giant Williams, Alan Armstrong. Williams will be reporting earnings after the bell today, but he joins us ahead of those numbers. So, Alan, let's first start on this Inflation Reduction Act, as they're calling it. What are your thoughts on the package and how it will ultimately impact your business?
Well, I would just say, certainly we are supportive of Senator Manchin and his efforts to get permitting reform for the energy industry, and that's not just for the gas pipeline industry, but really all forms of energy, including transmission for renewables as well. So we think ultimately that part of the bill, we haven't seen the details of that obviously yet, but we think that is extremely important to our nation and really to the globe. And so we're very hopeful to see what comes out in that permitting reform, and hope that bargain has been struck in a way that really will unleash the ability for the U.S. to help out the energy crisis around the world.
Alan, it's Guy. I'm in London. There's the potential for it to get cold here this winter. You talk about unleashing U.S. nat gas. Can you give me a kind of quantum of what we're talking about here, what the potential could be and how quickly it could come?
Yeah, well, the quick is the problem. Plenty of natural gas here in the U.S., about 3,000 TCF of recoverable reserves. And so just to put that into perspective, that's about 86 years at our current use rate here in the U.S. And if we were able to deliver the demands for Europe as well on top of that, that would still be over 50 years. And that's just with the existing technology that we have today, and that continues to increase. So we have the capabilities, but it is not a short-term issue. It's a very long-term issue. There's been 4 major natural gas pipelines that have been blocked by opposition here in the U.S., and we finally are having to pay for that. The challenge with long-term infrastructure is it is a long-term issue. And so in the short term, we push against things like that, but in the long term, it really piles up, and it's going to mean much higher utility bills, not just for Europe, but here in the U.S. as well, as we continue to limit our ability to get our supplies into the markets that are desperately going to need them. And so people are very focused today here in the U.S. around high gasoline prices. I know there's no sympathy for that in Europe, given the much higher prices for energy, both gasoline and for natural gas. But we've really got an opportunity to contribute, but it's not in the short term. It takes time to get the infrastructure built. We do have one project called Mountain Valley Pipeline that is a 2 BCF a day pipeline. And if that would have been built on time, we would not have high natural gas prices right now in the U.S. And a lot of the pressure that's on inflation here in the U.S. also would have been alleviated, because we actually would be long natural gas. And so the impacts of actually stopping these pipelines is finally coming home to roost. And everybody wants a quick fix, but frankly, it's not a quick fix. Mountain Valley Pipeline, however, could be approved very quickly, and we could get our gas supplies back in balance here in the U.S. very quickly.
Well, let's focus on one other infrastructure issue, the Transco pipeline. Obviously, there are some constraints there in getting natural gas supply to the southeast that is leading to higher prices. Can you just give us an update on that in particular and when you expect that those constraints may ease?
Sure. So Mountain Valley Pipeline, which I mentioned earlier, actually connects into our Transco pipeline, or would connect into our Transco pipeline. And we have then the capacity to serve incremental markets, move gas south into the LNG space, as well as right now what's really going to be driving much higher utility bills is high power generation prices. And so the sooner we get that built and connected, the sooner we'll see gas prices come lower, and some of the spiking that we're going to see through both here in the summer months when power generation loads are high and during the winter when heating loads are high. And really, it's not that hard to get that done. That pipeline's 94% built, but it's been taking, I think, 7 years now for that pipeline to go through the permitting process.
Alan, during that time, inflation has gone up. Talk to me about what build costs are like right now.
Sure. You know, actually, we've actually seen steel prices, which obviously is a big part of pipeline industry. We've actually seen steel prices come off pretty dramatically here over the last month and a half. And so we're encouraged by that. We are seeing high price, obviously, like everybody else, glycol, lube oils, a lot of the things that we use in our industry as well. Prices have gone up on that. But not really in a way that's disabling to our industry at all. And what I think one of the things that people miss about inflation is a little bit circular for our industry, but people misunderstand that food is heavily driven by natural gas prices. The fertilizer that is used for food, most of that comes from natural gas. The packaging for food, most of that comes from natural gas. The transport for food comes from, obviously, from gasoline and diesel. And so the impact of energy, when we obstruct our own infrastructure from getting built, the impact of that is coming home to roost. But it is pervasive through what we call core inflation, because so much of our core inflation uses energy for it to be produced.
Well, Alan, we only have about a minute left, but how high do you anticipate prices could ultimately go?
Well, I think, I've been in this long enough, I'll never think I'm smart enough to call prices, but I will say that it is likely to be very volatile if we don't get some of this infrastructure built out pretty quickly. Demands are continuing to increase on our systems. Despite what you hear, demands for natural gas continue to go up. Freeport LNG, when that comes back on, that's an incremental load as well. So the demands are there, and the demands both domestically and globally are growing, and we've got to be able to connect our supplies from places like the Marcellus.
Yep. We look forward to that happening. Alan, great to catch you up. Really appreciate the time today. Thank you very much indeed. Alan Armstrong, Williams CEO and President. This is Bloomberg. So August is upon us after a cracking July when it comes to stocks. Today, we see that rally continuing. The Stoxx 600 up, as you can see, by only 0.1%, but it's a really mixed market. What we're seeing is banks doing well. Think about the HSBC numbers we've seen today. But energy at the other end of the spectrum, with oil down on the China data, certainly adding some weight to the bottom of the market. The euro is up. We watched that ISM data come through out of the States. Pretty strong, I thought, as we were seeing on the MLive live blog on the Bloomberg. Cameron Christ talking about this being almost a Goldilocks number. But the euro is up by around 0.5%. And the Italian 10-year is really where the bid is today. The bond market's certainly catching a bid. Some suggestion maybe that the next Italian government, even if it was led by the far right, might actually stick to the Draghi economic commitments. That would be good news in terms of drawing money in from Brussels. The Italian 10-year, therefore, as you can see, yields coming down very, very sharply. 2.8% is where the yield is now. We're just getting some news on Nancy Pelosi. You want to pay attention to that. Bloomberg News now reporting that Nancy Pelosi will visit Taiwan. Is that going to be an inflationary story as China and the United States get further apart? We'll discuss that next. Barney Buwaja, Chief Strategist at UBS Investment Bank, joining us. This is Bloomberg.
This is Bloomberg.
Monday, the 1st of August. European stocks are higher, just banks are up, energy is down. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
30 minutes to close. Markets look a little bit like this over here in Europe. Equities bid, but only just. Banks are up. Good numbers out of HSBC, but energy acting as a significant anchor. The China data, a huge factor behind that. Brent and